Uses of accounting information. There are 10 uses of accounting information. First one is owners or shareholders. Why owners need the accounting information? First, they need to understand the performance of their investment. Next, to track the performance of the business and help in making investments decisions such as expanding their businesses or closing the unprofitable segment. And to make decisions whether to hold, sell, or buy more shares. Second, prospective investors. Prospective investors need the accounting information to assess the profitability and solvency of a business. And they want to know the track record of the business so that they would reduce the risk. Third, management. Management need the information to make proper operating decision. Corrective action can be taken if the business fails to achieve its target. 4. Lenders. Lenders interested in the business's ability to pay the debt. Use the financial statements to estimate the ability of the borrower to pay back all loans and related interest charges. 5. Trade creditors or suppliers. Trade creditors or suppliers need the accounting information because they are interested in the business ability to pay obligations when they become due, particularly information on the business liquidity in order to decide whether it is safe to extend credit to a business. 6. Government. The government agency, especially the tax authority and customs department, such as the Inland Revenue Board of Malaysia and Royal Malaysian Customs Department, would refer to financial statements in order to determine whether the business paid the appropriate amount of taxes. 7. Employees and unions. Employees and unions will assess the ability of their employer to pay salaries, provide employee benefits, possible business expansion, and career development opportunities. That's why they need the accounting information for the company. 8. Customers. Customers ascertain the financial ability of a supplier to remain in business as to maintain the stability of operations. This is critical for a customer who is considering a long-term involvement or contract with the supplier. 9. Competitors. Competitors need the accounting information to evaluate its financial condition. The knowledge they gain could alter their competitive strategies. And last but not least, rating agencies and investment analysts. To give a credit rating to the business as a whole or to its securities, and to evaluate the financial statements in order to decide which business they should recommend to their clients for investment purposes. There are 6 areas of accounting. These areas of accounting are interrelated and have been developed to serve different sets of objectives. First one is financial accounting. Financial accounting is a process of recording business transactions and summarizing them into financial statements, which are supplied internally within the organization and externally to various users such as investors, creditors, and government agencies. Second is management accounting. Management accounting put emphasis on the preparation and analysis of accounting information within the organization. Among others, it includes preparing and evaluating business processes, costing, budgeting, and forecasting. It also involves implementing and monitoring internal activities and resources. Next is tax accounting. Tax accounts, tax accountants help entities to minimize their tax payments. Within the corporation, they will also assist financial accountants in relation to accounting for income taxes for financial reporting purposes. In the Malaysian context, RRBM and RMC are the bodies governing and collecting the corporate tax and sales and service tax respectively. Fourth is auditing. Auditing is a process of examining and verifying business accounts and the firm's system of internal control. Auditing is usually performed by both external and internal auditors. The external auditors are independent firms that inspect the accounts and financial statements of an entity and render an opinion on whether the statements present fairly the financial position of the business and the results of operations. The internal auditors evaluate the risk the organization faces and ensure effective and efficient operations, reliable financial and operational information, and compliant with laws, regulations, and contracts. Next is forensic accounting. Forensic accounting is a process of investigating and analyzing financial evidence, followed by giving expert advice in legal matters, including bankruptcy, falsifications, and manipulations of accounts or inventories, insurance claims, negligence claims, fraud, anti-money laundering, royalty audits, and even family and marital law. The forensic accountants play critical roles in the investigation of fraud and normally being called in if any red flags are detected by a business, internal financial group, or as a result of a routine audit. Last one is public sector accounting. For government entities, public sector accounting is used to ensure proper allocation and segregation of resources to government departments. In practice, an organization normally distinguishes between a general fund and special purpose funds, in which the general fund is used for day-to-day operations, while special funds are established for specific objectives. Accounting process. During each financial year, a sequence of accounting procedures called the accounting cycle is performed. The accounting cycle begins with the analysis of business transactions through source documents and ends with the preparation of financial statements. The cycle represents the flow of information from the beginning of the recording process up to the preparation of financial reports. The steps in the cycle are performed in sequence and are repeated in each period. The steps involved in an accounting cycle are shown here. First, we will start with source documents, and then we will record the source documents in journal. The next step, post the journal to ledgers. Then we will prepare the trial balance. Next, we will do the adjustment And next, we will do the closing entries, prepare the financial statements, and last step is doing the reversing entries. Specifically, the steps involved are: first, identify the transaction from various sources, documents such as invoices, purchase orders, bank statements, cash bills, and etc. Second, record the transaction into the appropriate journal. The journals comprise of sales journal, purchases journal, return inward journal, return outward journal, cash receipts journal, cash payments journals, and general journal. Some automated accounting system skips this step where they record directly to the accounts in ledgers. 3. Post the entry in the individual accounts in ledgers, traditionally known as T accounts, with debits on the left side and credits on the right side. Another format of presenting ledger is a 3-column ledger account. 4. Prepare a preliminary trial balance which stated the balances, either debit or credit, for all the accounts at the end of the reporting period, such at the end of the month, quarter, of year. The debit and credit balance must be equal. 5. Make adjusting entries for periodically recorded transactions that not derive from specific source documents, such as depreciation and other provisions. 6. Prepare an adjusted trial balance of the accounts, which is after considering all the adjustments. 7. Prepare the financial statements such as the statement of financial position, the statement of profit or loss, and the statement of cash flows. And last, 8. Perform reversing entries to start fresh in the new period, month or year. Thank you very much.